These have never gone to zero. Why? Because they have full functionality and absolutely broadest base of demand. You decide what you want to go into this battle with. One place, every place. Give me every place. Give it to me. That's what I want. That's always what we want. So you can see where these boxes are, and if you can see that blue line, there's only so far above or below that it goes before it comes back to that line, back and forth. Now, 10% away from that line is already considered a lot. So we have to keep that in mind as we move forward. But can you see what I'm talking about? And with the correction, in other words, the spot price of silver coming back down, well, there's always, I've talked about support and resistance, right? So here's how that works, right? Let's say support, and you were going to buy something, like you were going to buy spot silver when it was $36 an ounce, and you didn't do it. And then it shot all the way up past 50. Well, you're going, man, if it ever gets that low again, I'm going to buy it, right? So that creates a pool of buyers at that level. And so spot goes down, dips into that pool. There are more buyers. It pushes the price up. Spot goes down, dips into that pool. It needs to use up that pool of buyers before it can go to the downside. And the reverse is true on the top, and that's called resistance. So let's say you were going to sell it at over 50. And remember, 50 was the very long-term peak in that triple cup formation on the long-term spot silver chart. I've shown you that a gazillion times. I'll show it to you another gazillion. But that creates a pool of sellers up at that higher level. So spot goes in, dips into that pool of sellers, that pushes the price down, which is what we're seeing. That's one of the things that we're seeing right now. It goes up, it dips into that pool. When it uses up that pool of sellers, that's when it can break free and go to the other side. So we could potentially be testing that silver contract at that support level, and we'll get into it. I'm going to go to a closer chart right now. This is a 1-year chart, and you can see in this case that red line. Let's see, this is spot silver. Okay, you can see that red line is the 200-day moving average. That blue line is the 50-day moving average. When the spot price is above that 200-day moving average and the 50-day moving average, that is very, very bullish. But can you see how far stretched the spot market was from that 200-day moving average? And even going back through last night, because these graphs are from yesterday, right? I wanted to be as current as possible to show you this. It's still 22% above that 200-day moving average. So I frankly, knowing that this is a trading instrument and that it does not represent the true fundamental value of an ounce of silver, which is somewhere around $2,000, this is an opportunity to get in. Because with silver, for me personally, and you have to do whatever you're comfortable with, so I can just speak for myself. But for me personally, silver is my barterable position. So I don't really do collectible silver. I'm just looking for a variety of sizes. And in this case, I don't care if it's new. I don't care if it's old. I only really kind of care about the weight. And beyond that, it could be in any form, absolutely any form. Silver and gold at its base is monetary. So it's important to understand that. But can you see how far away we still are from that 200-day moving average? So if it corrects back down to that, if it even goes below it, I'm okay, because look at the direction of the 50-day as well as the 200-day moving average. They're in an upward trajectory, right? So remember, there's only so far above or below that it can go before it comes back to that average. So understanding the direction of that average is also really important to take note of. So if you're not clear on this, when we go to the Q&A part of it, I can pull these charts back up and we can look at them even more closely.
Support forms where past buyers regret missing an earlier price and vow to act if it returns. Resistance arises where sellers previously stepped back in, often after dramatic spikes. For silver, both forces are currently shaping every rally and pullback. Each dip consumes part of the buyer pool. Each surge collides with lingering sellers. Only when these zones are exhausted can price break cleanly through. Today, silver is approaching critical support levels, and the question becomes whether buyers still have strength in reserve. This tug-of-war is the backbone of every chart. Emotion, memory, and strategy imprinting themselves on price.
So this is really what's happening with spot silver. Additionally, remember, did the piece on backwardation come out yet, or is that coming out Saturday? All right. Make sure that you watch the piece on backwardation. Now, backwardation, this is true for both gold and silver, but is when the current spot price is higher than the futures price. So buying silver out in the future, because what's been happening with extreme demand is that people don't trust those future promises, and you shouldn't. And you shouldn't. We've had some entities, some large entities that usually, contracts for silver are like 5,000 ounces. They have different size contracts and they're making them smaller and smaller so you guys can participate. That's just a contract. It doesn't mean anything. But backwardation in both gold and silver is flippin' scary for LBMA or the COMEX or any entity that must deliver out that physical gold and silver, because it's very, very hard to come by the physical market, especially in the U.S., which is primarily a paper contract market. Don't be fooled. Take advantage of it, but don't be fooled, because they want you to stay away from it. And a lot of what's happening, and I think I saw it this morning, so I stuck a slide in there, so I'm probably going to be a little redundant on this, but in the ETFs, so SLV, GLD, have seen the largest outflow in a long time. So they saw this massive inflow pushing the price up. Now they take it out. That pushes the visible price down. But what's changed? What changed from a week ago? Absolutely nothing, other than those that would have to deliver out the silver are scared, because they know that the emperor has no clothes. They know that when push comes to shove, if they are forced to deliver out silver or gold, that they cannot do, because in the physical world there's a finite amount, then you're going to know that the emperor has no clothes. And they don't want you to know that, because they want to keep this game going and stay in power. And so you'll see something kind of similar with gold, but remember that spot silver had a much more stretched run. So as you can see, when you're looking at this chart, it is still, the spot silver market is still 22% away from that 200-day moving average. So if 10% away is considered a lot, then 22% would be extreme. It doesn't mean that it can't go back to extreme levels, right? Because we're seeing the same thing in all of the markets. Why? Maybe we're in the melt-up phase that I've been talking about, which is the last phase before the crash. I will do a piece on that so you can see it and what it looked like in different countries. That's coming up, and I will be working on it. That's going to take me a minute. So I don't have it for today because, as you well may know, I'll be traveling to do the show with Greg Manarino. We leave on Friday. And then we're going to Panama after that, and I'm super excited. You're going to meet some vaults down there and some people down there, and I'm super excited to be going. But we're going to share that with you in just a minute. So here's the spot gold chart, and it is still 17% above that 200-day moving average. But like spot silver, the price is currently above both the 200-day moving average and the 50-day moving average. Now, I want you to make sure that any questions that you have about this, you take a second to write down and put in the questions part, so that we can address them, because we can look at these charts again, and we should. But can you see also in this particular chart how the spot price was suppressed because it went up, and I didn't draw this line in, but it went up and hit that resistance level. People get frustrated because they think, well, nothing's happening with spot gold or spot silver at times, right? But it could just simply be working off that overbought, not overvalued. Those are two completely different things, but that overbought position. It has to do that. But also, it really is about your perception, because a rising gold price is an indication of a falling currency and also, a looming crisis. They don't want you to understand this because they need you to stay in these markets. So it's a bit of all of the above. It is a bit of working off the overbought position, not overvalued, overbought position, and it still remains technically overbought.
Recent data shows silver trading far above its 200-day and 50-day moving averages, historically a bullish configuration. Yet the degree of separation is extreme, hovering more than 20% above the long-term trend. Markets rarely maintain such heights, especially when the spot price diverges sharply from perceived fundamental value. Many analysts argue physical silver's intrinsic worth is vastly higher than paper contracts imply, making pullbacks appealing entry points. For accumulation-focused buyers, form matters far less than weight. With both major averages trending upward, even a sharp correction would simply realign price with long-term strength, not reverse the trend.
Understand that when it's also, we're in like this psychotic phase, right? Where one day everything is doom and gloom, and the trade talks and the debt levels and the defaults and this and that, and boom, there is a flight to safety into gold and silver. They want you to stay in the paper contracts. They want you to stay in ETFs. They don't want you to hold it physically. And make absolutely no mistake about it. If you own an ETF, you do not actually own physical gold and silver. All you own are shares in a trust that are designed to mimic or imitate the movement in the spot market, which does not represent the true fundamental value, 40,000 here about, and about 2,000 here. We're not even marginally near those. So you use any of these pullbacks, because let's face it, nothing goes straight up, nothing goes straight down. You always have to get bouncing along the way. And much as I know that for you watching and not really being a technician, that you like it when everything just keeps going up, and then you get nervous when there's a pullback. You need to understand, the more of this, that is being blocked. The more of this that they do, the less value that all of that money that they've already created out there has. That's the real trend, not stocks, cryptos, bonds, even gold, spot gold or silver going up. That's window dressing. The real trend is how they are devaluing the dollar. And as I've been telling you, woohoo, the devaluation trade is awesome. But what do we see? We see stocks hitting new highs ahead of the Fed rate decision. In other words, markets, corporations want the Fed, and certainly President Trump wants the Fed to lower the interest rates, which is really a cost on borrowing, a cost on this stuff, how much this stuff is worth. The reality is the lower the interest rates are, the less that value that has. Why? Because they want you to borrow and spend more. They want corporations to borrow and spend more. Why? Because that pushes more garbage fiat into the system, which then pushes the price of assets up. It also pushes the rest of the cost of living up as well. Then that makes the GDP look better, even as families are struggling to feed their families. But the GDP looks just great. Yeah, well, how much of those GDP numbers, especially since they came out, and don't hold me to this, I'll do a piece on it, with the new world numbers, and I think the U.S., they anticipate that going up by 3% next year. But gosh, inflation numbers just came in at 3%. And we know those are false anyway, because there's really no good data gathering. Additionally, they don't want you to realize it because, they brought some BLS people back in to create that inflation number so they could determine that they would give Social Security recipients a 2.8% increase next year. Does that cover the costs of living that are going up? Of course it does not. And that, my friends, is by design. And that, my friends, is why you've got to have physical gold and silver in your possession for your protection. Because gold and silver are proven 5,000 years inflation hedges.
Silver and gold have increasingly slipped into backwardation when spot prices rise above future delivery prices. This signals mistrust. Traders prefer metal today rather than promises months ahead. In physical markets, shortages intensify this effect, putting pressure on exchanges that must deliver real metal, not abstractions. Large institutions have quietly reduced ETF exposure, creating downward pressure on visible prices even though underlying conditions haven't changed. This behavior suggests mounting concern over deliverability. When physical supply thins, it exposes the fragility of a system built on paper claims. Backwardation isn't just unusual, it's a warning flare.
Daily flows recap. Okay, so I talked about this a little bit earlier. This just came out this morning. And so I'm like, okay. Gold sees major outflows. It's a manipulation tool. That's all that it is. What has changed? Oh, President Trump is having a nicer conversation with Xi. Woohoo! Has that really changed? How about the tariffs? Okay, so maybe they won't be as bad, but guess what? They're already in place and they're not necessary. And that is an additional tax that you and I will pay for. Corporations, what a great earnings seasons. Of course, they keep lowering their earnings expectations so that they can beat that guidance and have a reason to push the stocks up. And then you think, oh my gosh, everything must be okay. Look at the stock market making new highs. No, this is what happens in the melt up phase. Everything is ignored because there's just so much more of this in the system. And when they do that, that money has to go someplace, period. It just doesn't go into a vacuum. And once they create it, it's in the system and then it's sloshing around. And it can go from this asset to this asset to this asset to that asset, driving up the visible prices of everything. But again, it doesn't matter. Look I've got this $10 trillion Zimbabwe note and I can buy nothing with it. Because the reality is that any fiat money, its true fundamental value is zero. It is used in one place. These have never gone to zero. Why? Because they have full functionality and absolutely broadest base of demand. You decide what you want to go into this battle with. One place, every place. Give me every place. Give it to me. That's what I want. That's always what we want.
Gold remains elevated above major moving averages, yet its day-to-day swings often reflect investors' shifting emotions rather than true value. A rising gold price traditionally signals weakening currency confidence and heightened economic stress, signals policymakers prefer the public ignore. While short-term corrections relieve overbought conditions, they don't address deeper issues: expanding debt, political uncertainty, and declining purchasing power. ETFs mimic metal movements but offer no ownership of physical gold or silver, a distinction many overlook. Meanwhile, central banks continue devaluing currency through policy decisions that pump money into markets, inflating asset prices while households struggle with real costs.
So what about the physical metals? Well, the easiest place for me to show you that is through the PCGS 3000. These prices might be a little bit late, but it still gives you a really clear indication. This is the quality level that typically, and the date range that we typically use to build our sound money strategies. You can see pretty clearly, and I've shown you these charts before, you can see pretty clearly that cup formation, but we haven't broken out from the 2008 highs. However, we are still significantly below the 1989 lows. And that was when Wall Street participated. And I think it should be pretty obvious to everybody that Wall Street's starting to participate in the gold and silver markets again in a rather large way. And, you know, they've always got to find whatever that next hot thing is to push. This lies in the future. You want to participate? You better be holding it. Because the reality is if you don't hold it, you don't own it. And you know they want to digitize it, which I will never voluntarily do, so that ultimately you don't hold it and you don't own it. Don't fall for that trap. And they'll create a crisis to push you into it, just like they did in 2008. This is the way that they operate. So, while gold and silver that are just this raw stuff, right? So they kind of follow the spot market up or down. There's your opportunity. Yay, you want it pulled back. You don't want it overbought, but it doesn't really matter anyway. Honestly, the only reason why I ever look at the spot market is because I know you're looking at it, and I want to be able to answer your questions, and I want to be able to show you this on a technical level, because you need to keep a clear head and not believe the lies of Wall Street. It's amazing to me that anybody still believes the lies of Wall Street, how many times we've been burned.
Despite market noise, the underlying global trend is currency erosion. New money continually flows into financial systems, propelling markets upward in a melt-up phase that often precedes major corrections. Strong GDP headlines mask consumer hardship, and inflation adjustments rarely reflect true living costs. Physical gold and silver stand apart. They cannot be created at will, digitized away, or reduced to zero. Historical performance shows preserved value across crises, unlike fiat currencies that inevitably deteriorate. While paper markets fluctuate wildly, physical metals maintain universal demand and utility. When the financial cycle resets, only what you hold directly will matter.